This is a simplified model, very simple. This is of the Lenovo Group, and what I've done in this case is just look at revenue, costs, net profit, and then the dividends that are paid out of that net profit. And what we can see is that this makes for a very, very simple P&L. In the balance sheet, I've looked at current assets and long-term assets, minorities, retained earnings, and then my balancing item is other equity. Therefore, my balance sheet will balance. And I also look at supplementary items. We need to get the average shares outstanding to get our EPS and book value calculation. And then finally, I have the forecasting factors down below. So in this case, what I've done, and I will split the screen here, and I will split it horizontally, and that's the upper part, and we'll use the P&L at the upper part, and now I'm going to move the bottom part down to the forecasting. First thing I've done is I've calculated the revenue growth over the last couple of years, and it's been 30, 37, and 14.5. What I've now done is said, let's say it's going to grow at 15% over the next 5 years. So, next 3 years. So therefore, all I have to do is take the amount that it was in the prior year times the 115 divided by 100. I like to divide by 100, so I keep a number in here like 1.5 rather than having to enter in 0.15. And then I can copy that formula over to the right, and then I will be able to get my revenue growth each year. Then, of course, because this is very simplified, I've calculated a net margin, and then what I've just said is that this company's going to have, in this case, a 2% net margin. So all I have to do is multiply that 2% times the amount of sales that they have, and I get that. Then the costs are just a result of the two. So this is about as simple as you can get on a P&L. In the balance sheet, I've looked at asset turnover, and I've looked at trying to relate the amount of assets to the amount of revenue. So asset turnover is the amount of revenue you get per assets. So that's about, right now, asset turnover is about 2.1, meaning that revenue is 38.9 versus 18.5. So then all I have to do in that case is I've forecasted the growth in revenues. Now I bring that ratio into play and find out the relationship. There I go, and it's related to the sales, and then from that I can predict what roughly the total assets are. The next thing is to look at the amount of current assets, and it used to be about 73, so I'm going to keep it, let's say, at about 70. So there are the current assets. Now, of course, this is very simplified, so we can't see cash, we can't see accounts receivable and tie that into the amount of revenue. So this is simplified, but it's the beginning of a learning process. Liabilities, that's accounts payable and also debt, and it's all lumped into one. And I'm just looking at liabilities relative to assets, and I've brought it to 83 versus the 84 that it was. And then finally, we have the amount of shares outstanding and then some growth factor into that. I've put in 1, so I can grow the prior year's shares by 1%. Sometimes a very small amount could be a employee stock option plan. And then we have the EPS and the book value per share. All we have to do then is calculate the average shares outstanding over the year and then look at the net profit divided by that average, or the book value, which is the equity right there, divided by the average. So once we do that, we can get the book value per share, in this case 14.7. Again, in the P&L or in the balance sheet, the retained earnings, all we're doing in this case is just looking at the dividends paid out, and the rest is retained. There's no other adjustments that are made, which sometimes are made in real life.